This is essentially one of those rare podcasts where everything seems positive. Right? Hasn't happened in a few weeks at least.
Yeah, I'll give you negatives towards the end.
So
It can't be
negative
too
in the
good
valuation?
See, life's good, but it's not so good.
Hello and welcome to another episode of Taking Stock. This is a weekly podcast where every week we pick one stock, one company and deep dive into it. And this week we're going into a company, we're talking about a company which is famous for its tagline called Life's Good.
Oh, yeah.
Right? So this is LG India. I think the first thing that I want to sort of delve into is that LG recently had its IPO in India. And today, LG's market cap in India is $13 billion, correct? And it's about $3.5 billion more than its market cap in Korea. So how is that even possible?
Yeah, that's thanks to the Indian economy and.
So it's population.
No, not necessarily. I mean, yeah, in a way, it's because of potential.
Right.
Because if you look at the sales of the India entity, they're about 5% of the total global sales for LG Electronics.
Okay.
However, the market cap is still more.
Right.
So it's a function of India's potential being more.
Correct.
Because it's a largely untapped market compared to global markets.
Right.
For a lot of the goods that they sell, the penetration is still in like low single digits and stuff like that.
So how long has LG India been in India? And okay, let's start with the IPO, right? When did LG sort of launch with its IPO, or when did LG go public?
IPO is recent.
Recent.
Very recent.
Okay.
So
and it's had a successful IPO.
Successful IPO, one of those blockbuster listings, and 50% gains on the listing and stuff like that. So blockbuster IPO.
Okay.
But yeah, the 50% listing gains.
Right.
And then this has happened where it has sort of eclipsed the parent company itself.
Okay. So this is recently happened. This is post IPO where the market cap crossed the Korean
and
market.
Post IPO, in fact, the stock itself also has gone up 20-25% after the Indian IPO because it got such a massive response. And the value of this obviously adds into the Korean entity as well. So despite it being a fraction of the sales, its valuation is higher.
But so I mean, if you go back, I remember even seeing LG TVs in our childhood while growing up, right? So when did LG start in Korea first, and then when did it sort of launch in India?
India was in the 1990s, late 1990s.
Correct, yeah.
That's when, I mean, we were growing up and...
That's what I remember LG TVs being the sort of a big hype back in the day, and then it sort of very quickly phased away also.
I mean, other brands just came in.
Right.
It didn't phase away. I mean, the hype phased away because other brands sort of also came in.
Right.
And everybody established a mark.
Right.
So anyway, so I think it was also the period post-liberalization. So post-91, once the dust settled and regulations eased out. Initially, the thing was that any global player that wanted to come in India, they required a local partner.
Okay.
That rule, however, changed later.
Right. Post 1991.
In the 90s, all these rules changed. So actually, while LG came into India in 97, it made a couple of attempts to come into India before that as well.
Okay.
But it failed during that time.
Right.
Either because of the complexity of regulation or because it partnered with somebody local and then we don't know the status of what that partnership went into.
Right.
So it may be partnership issues, it may be something else, but it didn't quite become successful. But it was 1997 when it powerfully sort of launched into the Indian market. And since then it's been doing pretty
well.
And
how old is LG in, like, when did it launch in Korea? It's been decades.
That is 1958.
Okay.
So interestingly, the company is actually a merger between two companies.
Okay.
So there was a company called Luck Hui Chemicals. Okay.
Right.
This was a company that was formed in 1947.
Okay.
Right. They used to make like cosmetics and stuff.
In Korea, you mean,
Korea.
Right?
So the first facial cream in Korea was launched by this company back in the 1940s.
Okay.
And because Luck Hui in Korean means giving joy to all.
Okay.
But it sort of sounds like lucky.
Right.
So they named the brand Lucky.
Understood.
And the same family started a company in the 1950s, 1958, which made electronics.
Understood.
which is quite different from cosmetics.
Right.
But that company was called Gold Star.
Right. Okay.
And then in 83, Lucky and Gold Star came together.
And it became Lucky Gold Star, LG eventually. Right.
So the name change happened in sort of 1995, and then India happened in 97.
Understood.
So when LG happened, they also changed the tagline to "Life's Good" at that point, and that stuck.
So that's a global tagline, or was it just for India?
No, global tagline is
okay.
"Life's Good."
Because I think that's been quite popular, and that's sort of been a massive branding.
So a lot of people usually also think that the full form of LG is Life's Good, but it's actually Lucky Gold Star.
Correct.
Not even Lucky Gold Star, it's Luck Hui Gold Star.
Right.
So that's very interesting of the company.
So when LG when LG launched in India, you're saying 1997, right? So that's whatever, almost 30 years ago. But the IPO only happened recently. So what was happening in the last almost 27, 30 years?
They were becoming the largest player in India.
So they've done well throughout?
They've done well throughout.
Okay.
And it was one of those periods also when a lot of foreign brands came in post-liberalization. So you had your
Samsungs and Onidas.
Onida is Indian.
Isn't it Japanese?
No. So Onida, BPL, Videocon were the Indian companies.
players. Okay.
And then you had a lot of these global players come in, where Mitsubishi was there, Mitsui was there.
Correct.
There were these brands which had also sort of come in at that time, including Samsung. The ones to make it really big were LG and Samsung. These have stuck around for the last 30 years and have made a mark and are currently sort of, say, number 1, 2 when it comes to consumer electronics minus phones. So we're talking mainly ACs, refrigerators, washing machines, TVs, microwaves. If you include sort of these 5 products broadly, then LG would be the largest, followed by a Samsung, and then you've got your long tail.
Fair enough. So, sorry. So let's say, what I'm reading over here is, that initially a lot of these companies, or at least a lot of the Korean companies, their strategy was to sort of come up with cheap knockoffs of Japanese products, right? And this is where LG sort of changed its strategy and went into a more premium segment rather than a value and a sort of a cheaper knockoff, right? And that's what's worked for them.
Yeah, so one of the things that has worked for LG, like even if you look at the positioning of the brand right now, they're not really a mid-brand or a affordable brand.
They're a premium brand.
They are a premium.
They've always been one, right? At least from what I remember.
Yeah, they've always focused on sort of adding value, adding features, and then charging like a 10 to 15% premium to the mid brands. So I wouldn't say it's premium because like if you go into, say, for example, speakers or phones, you've got like Bang & Olufsen.
Correct.
You've got Bose, you've got Marshall, you've got these brands, right? So in any product, the premium brands will be this category, like your Dyson, Bosch. So those would be the brands. Then you've got the mid to premium brands, which are like your LG, Samsung kind of brands. And then you've got mid brands and then cheaper brands.
Understood.
So LG's positioning has always been mid to premium. But you're right on the fact that even before, like when they launched,
it's okay, we can continue.
So when they launched, what happened is the perception was that they're doing cheap Japanese knockoffs.
Correct.
And that was not the perception only for India, but that was the perception also for the global entity.
Okay.
And that perception is not...
So globally their strategy was, I don't know if you want to call it a strategy or a plan or whatever you call it, but what they were doing essentially was doing cheaper Japanese knockoffs globally.
That's been the strategy throughout.
Okay.
So the global strategy was in fact that.
Okay.
And I think it'll be a little bit of a history lesson, but just to give context, so there was a war in Korea post the World War.
Right.
So in 1945, the World War II ended. And till 1945, before that, for 35 years, Korea was actually ruled by Japan.
Right.
Now, post the World War II, like what happened in Germany, half of Germany was started being governed by the US, which is the west part of Germany, and east was Soviet.
Right.
Similarly, what happened in Korea was that north became influenced by Soviet, south became influenced by the US.
Yeah.
So post the war, Korea ended up with 2 allies. Number one, Japan, because of the rule and all of that, and because Japan itself was in doldrums, and then US as well, because US was actually using Korea as a base for the Vietnam War, for the Cold War itself, stuff like that. So they were getting a lot of funding also from the US.
Right.
Now Korea's strategy to sort of, and when the war ended, Korea ended up being a lot more poorer than at that point in time India, Ethiopia, Yemen, all these
So
countries.
India, and when Korea's Independence Day is.
No, I
It's the
don't
same as
actually.
India. It's 15th August 1947.
Oh, really?
Yeah,
Same
yeah,
day?
yeah. Same, exactly the same day.
Okay. Wow.
But you're right that Korea ended up being a lot poorer as a country, a lot more affected as a country than India did, and India was quite heavily affected.
Yeah. So in that, then the government strategy sort of to bounce back was to say that they'll do a lot of stuff in house. What we
Right.
hear of like Atmanirbhar
Correct.
is what they started doing,
Right.
but not in the best possible manner.
Correct.
So what they would do is Japan was doing very well on the tech front. These Casio, Sony, all these
Right,
brands
right.
Panasonic doing really well in Japan. These guys used to manufacture locally. So they were taking Japanese products, technology transfer was happening, and South Korea was manufacturing. Now they started also replicating that tech.
Right.
And they started making locally under these brands. That's when, hence, Gold Star came in 1958.
Right.
Samsung around the same time.
Correct.
There was Daewoo. There was several brands that
even your
came in.
Hyundai, Kia, all of
Hyundai
the
and
car,
Kia.
automobile brands.
So Kia also, if you look at, has had the perception for the longest time that it's a knockoff brand. They just make cheap cars in every single variant. Obviously, that perception is no longer there, especially after their India launch.
Yeah.
But if you look at, for example, when we were studying in the UK, if you look at the small Kia cars,
Correct.
the most downtraded cars were the Kia cars in the UK.
True.
So South Korea is sort of known for that. And after a while, obviously, like there has been a backlash for China, for example. There was a backlash for Korea as well, saying that, hey, you know what, you guys are stealing our technology and making cheaper knockoffs, so we're not going to give that technology.
Right.
South Korea then started
We're sort of forced to innovate.
Yeah. So then they got into that zone of saying that we'll design, we'll innovate, etc. And now it's become that.
Correct.
So similar strategy for India. If you look at initially, they were doing a lot of like just importing products, setting up, trying it out, experimenting with new products that were launched in Korea. And now they're innovating a lot, adapting for the Indian market, and that is what has worked for them.
Correct.
So as a brand, similar trajectory. What happened in Korea from 1950s to 90s is what happened in India from 1990s to now.
But okay, so now when we look at the current scenario, right, and as you said that since 1997, LG's just gone on an upward trajectory in India at least. We're talking about LG India here. So it's always been upward, it's always been sort of growing, it's always been building value. And so one of the aspects involved in that is the fact that they've not gone into the whole knockoff model, but they've actually added value to the final consumer. They've gone into the, I would say the, whatever you said, right? The mid-premium to the above premium category, or just below the premium, but above the average category. And the second thing is their manufacturing, right? So what's that all about?
So two things to their success is number one, I mean, they're the largest in India, right? I mean, if you look at the overall size of the market of the 5 products that I spoke of, it would be, and this is something we've taken from, I mean, there are no hardcore numbers for it, and so we rely on the best possible estimate. So we've actually taken this number from the Havells presentation.
Okay.
So Havells has also got a consumer electronics brand now called Lloyd. So Lloyd's presentation actually has some numbers which give us a fair sense of the market. So according to that, the market size is about 1 lakh crore.
Okay.
At this point in time. And if you kind of look at LG's revenue number for the last year, it was roughly 25,000 crores.
So it's about 25%.
Yeah, they've got a clear 25% market share in that.
So this is for those 5 particular products, which is
4 really. ACs, washing machines, refrigerators, TVs. I'm not really including microwaves in this.
Understood.
4 products. So in that, this is sort of 25% market share.
Which is big.
Which is huge. Which is huge. Also because there will be market share differences in each of the products. So if I look at
TVs, so you're taking an average sort of market share across the 4.
Across the 4,
Right.
So if I look at TVs, for example, right now, especially in the last 5 years, there's been a lot of influx of cheap Chinese brands coming into the market. So it started with Xiaomi coming in with a very cheap brand model. And then like LED prices overall had been slashed and there was immense pricing competition. So you're getting a flurry of inflow, big flux and inflow of like these brands coming in. However, that's not the same for say refrigerators or for washing machines. So market share is going to be differential across categories and within that between products. Like for example, the lowest tonnage for ACs, maybe LG is not the market leader there because that's the budget segment.
Correct.
But in the slightly higher tonnage ACs, you'll see LG as the market leader in that particular segment.
Understood.
So it's a highly fragmented market when it comes to the products itself.
Because every product has multiple different categories also.
Yeah.
Right.
Then even like machines have front load.
Correct.
Front load and top load. Yeah. And so within that, then, so for example, the one number I have is that front load washing machines, LG's market share is 40%. Side by side fridges, where you've got 2-door fridges.
Right.
There the market share is 40%. Then in OLED TVs, it's 60%.
Correct.
So it really depends on which segment you're talking about.
Correct.
But roughly, I think that's a great number.
But I think what you can sort of decipher from all of this is that in the premium category, right?
Yeah.
They will always sort of be market leaders. So let's say when you take TVs, in the cheaper TVs, they might not have a big market share, but when you take the premium segment of TVs, which is your OLED, then they will have a higher share.
Yeah. So then the pecking order is usually LG at the top and then Samsung.
Correct.
That's the typical pecking order in India at this point.
Right. Fair enough.
So
and what's been their manufacturing? I read about them having a massive manufacturing moat in India.
Yeah.
So what's that all about?
So interestingly, what's happening in this entire consumer electronic space, and especially when it comes to India now, is the rise and relevance of contract manufacturing.
Okay.
So that's been a very prevalent trend globally, in fact, where if you look at Apple, for example,
right,
they're not manufacturing their own products.
Correct.
They're designing.
Yeah.
Their primary job is to design.
Yeah. And it's all manufactured in China.
Now right? India as well.
Now
so
India.
India
correct.
Sort of,
Very recently.
So,
Correct.
China, India are the manufacturing hub. And they're only doing the design.
Right.
So I think after the whole smartphone wave where the Apple has come in, Apples of the world have come in,
right.
That's been the model where companies primarily focus on technology. They focus on design. They focus on building a strong brand. Whereas the manufacturing of the product is actually outsourced to another entity which you may not even have heard of.
Correct.
Because these are usually behind the scenes. They don't need to be branded. These are B2B players.
Right.
So in a lot of cases, you wouldn't have heard of those brands. Now, being in the markets and these stocks having done really well, we hear of those names very well or very often.
Right.
But if I talk about like Dixon Technologies,
right.
PG Electroplast, EPAC Durables, Amber Enterprises.
They're not household names for sure.
They're not household names,
right.
but everybody's using products that they've made.
Correct.
So if I look at any of these companies, PG Electroplast, for example, the customers are Astral, Blue Star, Godrej, Whirlpool. EPAC Durables, there's Samsung, LG, Voltas, Lloyd, Bosch.
Right.
Dixon, Samsung, Xiaomi, OnePlus, Bajaj, Godrej.
Right.
So literally everybody is doing either part or full manufacturing through contracts.
Understood.
Right. So what that essentially does is, now if you look at contract manufacturing, you're adding a whole layer of,
because they're all going to add their margins to
it.
Right?
Yeah, exactly.
Yeah,
so what ends up happening is that there are several pluses and there are several minuses for doing such a model.
Right.
Why you don't do such a model? Because time to market.
Correct.
If you're a new brand, you want to come into India, you want to come fast. Why set up capacity? Just give it to somebody else.
Right.
If you are an electronics brand, your focus mainly is again brand and tech.
Correct.
So why do the manufacturing yourself?
Right.
Give it to somebody else, right? And why does like an Apple or any of these brands also get a massive premium when it comes to valuations or whatever? Because they're focusing not on manufacturing, which is inherently a lower margin business.
Right.
They're focusing more on tech and development, which is high margin stuff.
Right.
Now, why has it benefited someone like a LG?
So essentially what you're saying is LG hasn't gone into the contract manufacturing space.
If at all it has in a very little way.
Right.
Most of its manufacturing, unlike the others, happens in-house.
And they've set up their sort of manufacturing units in India.
In India. So, in fact, as soon as they came into India in 97, the first thing they did was set up a facility in Noida.
Okay.
A few years later, they set up a facility in Pune.
Right.
Now they're setting up a facility in Andhra.
Right.
So they're setting up massive manufacturing plants to just build these products in-house and take it to the millions in terms of production capacity. One of the things, so in terms of pluses, right, why has it worked for LG? Number one, it's worked because vertical integration always lets you sort of save margins and
of course,
avoid 10-15% being given to somebody else, right? So that's
right.
One. Second is the fact that in a lot of these cases, there are critical components which are imported.
Right.
So when it comes to fridges and ACs, for example, the compressor is a
Right.
very important part in either of these products.
Correct.
The compressor would roughly make up for about 25 to 30% of the total value of the product itself.
Right.
Now, compressor capacity in India is very minimal.
Okay.
Mostly, this is imported from other countries.
Right.
Because it's a highly specialized product, it requires a lot of intricate manufacturing.
Right.
And it requires a lot of capital expenditure as well when setting up. So it's not a 100 crore, 200 crore project. It's a larger ticket size project.
Right.
So in that case, usually what people end up doing is that they end up taking it from somebody else. Now, these guys, LG have their own compressor capacity, and not a lot of people have.
So they're not dependent on anybody in terms of importing compressors. All their compressors, or at least majority of their compressors, are made within their own facilities.
I would, in fact, go to the extent of saying that a lot of existing refrigerator brands or AC brands, which are competitors, also end up buying compressors from LG.
Because you'd rather buy it from India than import it from a different country.
Yeah, and very few players have got that capacity in any case.
Right.
So the popular ones when it comes to capacity in the compressors market is LG and Samsung again. And then you've got the Japanese players. So you've got Panasonic, Hitachi, Mitsubishi, which are also pretty big on compressor manufacturing.
Right.
So most of the players are either domestically acquiring it from LG or Samsung, or they are getting it imported from either LG or Samsung or the Japanese players that I spoke of.
Understood. So how is this turned out to be a? So I mean, I get the fact that they are the only ones, or one of the only ones sort of manufacturing compressors in India, right? So correct me if I'm wrong. The major benefit here then is that because you're not importing it from elsewhere, you don't have to pay extra margins, import duties, tariffs, etc. Is that the major benefit?
Yeah, so the major benefit that LG gets in this entire process is the fact that they are one of the lowest cost manufacturers.
Understood.
Whereas they are not the lowest cost sellers. So they are mid to premium sellers,
right?
But they are the lowest cost manufacturers. Right. And that gives them a very large advantage in terms of just profitability, pricing, power.
Right.
So if tomorrow there is a flood in the TV market and they're losing market share, they're bleeding and new players are coming and taking it, they'll be able to control their market share by saying that let's cut out a little bit of profitability because we can afford to. Whereas somebody else may not afford to.
Right.
Like I remember one of the players, in fact, Lloyd itself was planning to launch TVs at that point in time. They in fact launched, and then this entire scene happened where 20-25% pricing erosion happened because Chinese players came in, and these guys had to halt their plan.
And that wouldn't happen with an LG.
That wouldn't happen with the LG. LG would be great with that. One of the effects of that also is reflected in the margins for LG, where, for example, LG's margins are currently in the 13% is what the FY25 number is, and the steady state margin can go up to like 15-16%. However, the others are not really there in terms of margins.
Understood.
Because they're doing contract manufacturing and they're doing a lot of import of these critical parts. The others are at a margin of between 6 and 9%.
Okay, so they're almost sort of 50-60%.
So the third advantage LG also has is the scale.
Right.
So you've got scale, you've got backward integration, and you've got local manufacturing.
Correct.
All three resulting in a margin advantage and a return ratio advantage as well. So it's not only about the profitability and income statement levels. If you look at the ROE, ROC, again, LG's ROC and ROE are in the 45 to 47% range. Whereas the others would be in like teens to little higher.
So this is essentially one of those rare podcasts where everything seems positive. This hasn't happened in a few weeks at least.
I'll give you negatives towards the end.
So negative in the valuation?
See, life's good, but it's not so good.
So basically you're implying that there's a problem in the valuations. That's where the negative stuff lies.
Actually, not really. I mean, the markets may be considering that, but I may not really be exactly aligned to that opinion. So here's the thing. So if you value it on a FY27 basis, like we've been doing so far with other stocks, it's trading at a price to earnings of roughly 30 times. If I just take some broker estimates and put the math in, and an EV EBITDA of about 20 times. Now, if I have to look at this in comparison with the Havells, Voltas, Blue Star, which are also listed, then LG is actually trading at a 35 to 40% discount to the peers. So usually, like if it's trading at such a deep discount, either there is something wrong in the company or it's great and you got to mop it up.
Correct.
One of these two.
Okay, so which one is it?
I'm not going to explicitly say it out, but here's the thing, right? My logic of why it should not deserve such a large discount is rooted in the fact that, one, it's the largest player.
Correct.
It's got a 25% plus market share.
Yeah.
So usually we've seen that in India and anywhere in the world, the market leaders usually get a steep premium compared to the peers. It's not a discount because of their sheer size, scale, etc., whatever we've spoken about, right, in terms of benefits. Number two, it's got superior financials in terms of both profitability as well as ROEs. So financially as well, it's better placed. Third, it's placed in the mid to premium segment, which is again better positioning compared to the others.
Correct.
Fourth, it's got a global parentage versus the others, where again that's a plus point. So these things would make me sort of say that it should not trade at that bigger discount, but perhaps why the market is giving it such a steep discount, I'll just highlight those reasons. In that, there is, I think, 5 or 6 reasons actually. One of them being that growth is actually lower than peers.
Okay.
Because peers
year-on-year growth, you mean?
Yeah.
Okay.
So while this must be growing at about, say, 12 to 13% CAGR, the peers have grown at, say, mid-teens or higher.
Right.
But that can also be a function of scale. These guys are at a certain level in terms of size, and you can't continuously grow at that level.
Correct.
Or whenever there are new entrants in the market, obviously the ones, on a smaller base, they are bound to grow faster. Right. So that is one of the reasons why the market may be giving it a discount. Second is that the IPO was mainly as an OFS, which was an offer for sale, basically the promoter getting out a little bit, and domestic or foreign institutional investors and retail investors buying in.
Right.
So company didn't really receive any money for growth.
Understood.
But that can't be too legitimate a reason according to me, because the company doesn't need money for growth.
Correct.
So what is the fuss about?
Right.
The third reason that usually people cite is the royalty expense, which is pretty high according to people.
Okay.
It's at about 2 to 2.5% of revenue
that they're paying to the parent Korean company. Yeah.
Yeah. So there, I think, again, I'm not in full agreement with that, because number one, 2.5% is in line with what usually is charged for electronics manufacturers or tech transfers and stuff like that.
Right.
FMCG can even go as high as 3 to 5%, right? But okay, margins are also higher.
Right.
So even at 2.5%, the trade-off is that you are not doing your full R&D here. Of course, you're doing some amount of it.
Right.
You are localizing the product, which you're not really, which you can't do sitting in South Korea.
Correct.
Like a lot of like the localization examples, which we didn't really speak about earlier, is that, for example, in fridges here, you've got special trays for masalas.
Right.
Then you've got a freezer section which can be converted into a refrigerator section, because Indians tend to sometimes
need more space.
Yeah, guests come over, you have a lot of food leftovers.
Correct.
You want to convert the freezer section into this.
Right.
Separate vegetable and fruit trays, because India has more vegetable and fruit consumption than developed nations.
Right.
They're more meat.
Correct.
So there are these minute differences where, again, that R&D is taking place, but it's not hardcore tech.
So the main R&D is coming from the parent company.
Yeah.
That's where that's what the royalty is being paid for.
It's a royalty.
Right.
So my simple logic is that if you weren't getting that technology from there, you would set up an R&D department in India.
And you would spend pretty much the same amount. Yeah.
Right? Instead of that, if you just had to pay a royalty to somebody, sure, why not? It's not really impacting your financials for you to get a lower valuation. The one legitimate reason that I find the discount for is that there is an outstanding tax claim of about 4,700 crores on the company.
Right.
This is due to disputed income tax, excise duty, and service tax, and all of that. And there is some transfer pricing adjustment, which was a problem with respect to royalties.
Right.
So that liability is worth about 73% of the total net worth of the company.
Correct.
So if that becomes a real deal at some point in time,
then obviously that's a massive
then
hit.
There's an erosion in the net worth of the company.
Correct.
And to the extent of 3/4 of the net worth. So that, I think, is a legitimate one. But do you want to give it a 35 to 40% discount for that reason?
Right. So this is something that is being disputed currently, I'm assuming.
Yeah, and it's like an ongoing latakta talwar type issue.
Correct.
It will fall if it has to. It will get solved if it has to. You never know.
Right.
You can't take a call on how regulation will turn out. So that's something which seems legitimate, but in my opinion, 35 to 40%, I'm sorry.
Right. Fair enough.
So in a nutshell, life's good.
Life's good, exactly. And that's what I was saying, right? This is the first positive podcast we've had in a while. But anyway, let's quickly jump into the community question for this week. So basically, for contest, community questions are across the week. We get a lot of questions on our socials, and we every week pick one question which Sagar answers. This week we've got Sampad Jain from Mumbai. Sampad's basically asking you, Sagar, I plan to invest in the Nifty 50 index funds, but there are multiple options available. Which one should I go for, and what parameters do you look at? Simple question, I guess, no?
Yeah, pretty simple, because if you're investing in a Nifty 50 ETF, there's going to be multiple options available.
Right.
The one simple job of any of these options is to replicate the index as is.
Correct.
So you don't go horribly wrong in it.
So the composition of all those options will be the same.
Yeah, because it's a passive fund.
Correct.
It's not active management, it is
Right.
passive. So you're just supposed to mirror an index.
Right.
That is about
Right.
it. However, I think I would look at 2-3 things, and
Okay.
that's what I would encourage Mr. Jain to probably just create a matrix of this. So create rows of all the ETFs available. And in the columns, you want to probably rate these ETFs on certain parameters.
Okay.
Number one is the reputation of the AMC itself. Because you want them to be stable, you don't want them to die, you want them to whatever, right?
Right.
Second is the size of the fund. And that becomes important because liquidity is an important criteria. If you want to buy and sell worth a certain amount, ETFs in India, because they're still nascent,
Right.
has had a problem of lower liquidity.
Right.
So when you, for example, want to buy something but there is no supply in the market, there'll be an impact cost, which
Correct.
is basically demand-supply mismatch, will
Right.
result in a little bit of a higher pricing
cost.
for you,
Right.
which you want to avoid. Because anyway, it's a passive instrument, so you want to save on cost as much as
Correct.
possible.
Correct.
The third one would be that in ETFs, usually the secondary market is not the only important thing. You can have creation of units at a primary level as well, where APs create units, and whenever there is more demand than supply, there is unit creation happening. So you want to go with larger AMCs because more participants would be involved in that process, and
Right.
hence, even at a primary level, liquidity creation will not be a problem.
Makes sense.
Fourth would be plain simple expense ratio, because it's something that is passively tracking the index.
So go for the one with the lowest.
Go for the
expense.
lower ones. Fifth one would be there's something known as a tracking error, which you'll get this data on Morningstar or any of the portals. Paid promotion show.
For Morningstar.
So you get a tracking error, you just see that the tracking error should be really low. Because they're supposed to be tracking the index, and hence that number should be as low as possible. If you've got these things in place, rate the AMCs. And I already kind of, I don't know why I gave a long answer. Mostly it's going to be Nippon, which will come out at the top. Nippon
Right.
SBI, one of these. But
Fair
do
enough,
your
yeah.
research before investing.
Okay, great. Sounds good. I think that's all for this week. Thanks a lot for listening, and stay tuned. We come up with new podcasts and new stocks that we sort of dive into every Tuesday. We also have started a guest episode podcast, which happens once in a while, and we release those on Friday. So tell us in the comments what stocks you'd like us to cover, and thanks a lot for listening.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.